Bismillahirrahmanirrahim. Hi everyone, welcome back to the another video. Today in this video, we are going to learn the third type of reserve, which was investment fluctuation reserve. In previous video, we have already discussed general reserve as well as workman compensation reserve. If you have not watched the previous video, then first of all, watch the previous video. Link will be available in the description. After watching that video, you should watch this video. Okay, see here, the third type of reserve is investment fluctuation reserve. Investment fluctuation reserve. Investment fluctuation reserve is a reserve which is set out of profit to meet fall in the market value of investment. Suppose you have invested rupees 1 lakh into the market. This is your book value. After a certain period of time, the market value of your investment may be equal to your book value, equal to your book value, or it may be lower from your book value, or or it may be higher from your book value. Then for the fulfillment of these losses or for meeting up this liability, the firm create a reserve which is known as investment fluctuation reserve. This is also a type of specific reserve, not the general reserve. If the market value is equal to the book value, in this situation, there is no need of reserve. It means your reserve account amount will be distributed as it is. But if your market value is lower than the book value, then what would be happen here? Because you have invested 1 lakh, but in market you are getting your invested value only 80,000. It means 20,000 you are getting loss here, and this loss will be adjusted from the investment fluctuation reserve. So for the fulfillment of this loss, investment fluctuation reserve is to be created. And if market value of investment is higher than the book value, then there is no issue. You will not utilize that reserve. Therefore, fall in the market value of investment amount will be fulfilled from the reserve account. That's why we create the investment fluctuation reserve. In investment fluctuation reserve, here there may be three cases. First case, market value of investment will be equal to the book value of investment. Or second case, the market value of investment is lower than the book value of investment. And third case, the market value of investment is higher than the value of investment. The first case is here when the market value of investment is equal to the book value. Then what you will do? Suppose, just for example, your investment fluctuation reserve is rupees 1 lakh, and the book value of your investment is rupees 3 lakh, like this, and the market value of your investment is also 3 lakh. It means you have create reserve how much? 1 lakh. Book value of your investment, book value of investment in the sense this is your investment amount, how much? 3 lakh. Market value also 3 lakh. It means your market value is equal to the book value. In this situation, what would be happen that your reserve amount will be distributed among the partners capital account. So here we will make the entry which is investment fluctuation reserve account debit to partners capital or current account. In which ratio? Old profit sharing ratio. In old profit sharing ratio, we will adjust this. This is the case 1. Now come to the case 2. When when the market value when the market value of investment is lower than the book value. When the market value of investment is lower than the book value. In this situation, what would be happen? Here there may be three cases. The first case will be that fall in the market value of investment is less than the investment fluctuation reserve amount. Second case, fall in the market value of investment is equal to the investment fluctuation reserve account. And third case, fall in the market value of investment is more than the investment fluctuation reserve amount. See here, first case will be here, fall in the market value of investment, fall in value of investment is less than investment fluctuation reserve. It means, for example, your investment fluctuation reserve is 50,000, like this, and your book value means investment value is rupees 1 lakh. Your market value is just like 80,000. Now in this situation, this is the case of fall in the value of investment is less than investment fluctuation reserve. Here what would be happen? Here what is happening? Your book value is 1 lakh, but your market value is 80,000. It means fall in the value of investment is how much? 20,000. And you have created reserve how much? 50,000. It means this is the situation where fall in the market value of investment is less than the investment fluctuation reserve amount. Now what entry we will pass here? Here we will make the entry which is investment fluctuation reserve account debit to investment account. It means the amount of 20,000 will be adjusted from the reserve amount, and the remaining 30,000 amount will be credited to the partner's capital account. So the remaining balance will be credited to the partner's capital or current account. This entry we will pass. And for this partner's capital or current account, old ratio will be used here. Remember this also. So this is the first case where the fall of investment is less than investment fluctuation reserve. This is the first case where fall in the value of investment is less than investment fluctuation reserve. Now come to the second case. Here what may be happen? Fall in the value of investment is equal to investment fluctuation reserve. It means, for example, your investment fluctuation reserve is 60,000, like this. Book value of your investment is rupees 1 lakh. The market value of investment is just like 40,000. Here what is happening? Book value is how much? 1 lakh. Market value is how much? 40,000. How much the value of investment is falling from the book value to market value? 60,000. And you have created reserve also how much? 60,000. It means the full amount of fall of investment will be adjusted from the investment fluctuation reserve. So here what entry we will pass? Here we will pass the entry investment fluctuation reserve account debit to investment account, because fall in the value of investment is how much? 60,000, and your reserve balance is also 60,000. So full amount of reserve will be adjusted with fall in the value of investment. This is the second case. Now come to the third case, where fall in the value of investment is more than investment fluctuation reserve. What would be happen here? Just for example, suppose your investment fluctuation reserve is rupees 50,000. Book value of investment is 1 lakh, and your market value of investment is here 40,000 as it is. What is happening here? Book value how much? 1 lakh. Market value is now how much? 50,000. How much the fall in the value of investment? 60,000. Here you have created the reserve amount how much? 50,000. It means 10,000 is happening loss here. Then what entry we will pass? First of all, we will pass entry investment fluctuation reserve account debit to investment account. Here revaluation account will be created. Debit. Your fall in the value of investment amount is 60,000. What was your reserve? 50,000. Then this 10,000 will be goes to the revaluation. And now the second entry will also be passed here, which is partners capital account, partners capital account or current account debit to revaluation account, because this amount of revaluation will be debited from the partners capital account. So these were the three cases under which the market value of investment is lower than the book value. Now come to the third situation, where the when the market value of investment when market value of investment is higher than book value. Higher than book value. In this situation, what would be happen? First of all, we will do that whatever the reserve we have created. Here the situation may be investment fluctuation reserve. Suppose you have created 40,000 like this. Your book value of investment is 1 lakh and your market value of investment is 1 lakh 20,000. This type of situation will be arise here. Book value of investment how much? 1 lakh. Market value is how much? 1 lakh 20,000. It means 20,000 is more. Market value is 20,000 more than the book value. What we will do in this situation? First of all, we will have to adjust this reserve amount with the partners capital account. So first entry we will pass here, investment fluctuation reserve account debit to partners capital account or current account. Reserve value of investment will be adjusted here. Then after we will make an entry for increase in the value of investment. Here we will make the entry investment account debit to revaluation account. Here revaluation account would be credit because value of investment is increasing. And last entry what we will make, this revaluation amount will be credited to the partner's capital account. So we will have to make the entry revaluation account debit to partner's capital or current account. So this treatment will be happen when the market value of investment is higher than the book value. The general entries we will have to pass here. This is all about the investment fluctuation reserve.